Recent events have the potential to create a revolution in Australian finance. We explore the 72 hours that changed banking forever. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 10th of February 2018. In our latest weekly digest, we start with the batch of new reports, all initiated by the current Australian government, and which combined have the potential to shake up the financial services sector and reduce the excessive market power which the four major incumbents have enjoyed for years. On Wednesday, the Productivity Commission, which is Australia's independent research and advisory body, released its draft report into competition in the Australian financial system. And it's a doozy. And if the final report, after consultation, takes a similar track, it could fundamentally change the landscape in Australia. They left no stone unturned. And yes, customers are at a significant disadvantage. Big banks, regulators, and government all cop it, and rightly so. They say that Australia's financial system is without a champion among the existing regulators, because no agency is tasked with overseeing and promoting competition in the financial system. It has also found that competition is weakest in markets for small business credit, lenders' mortgage insurance, consumer credit insurance, and pet insurance. The report demonstrates the interlinkages between different financial entities and their links to the four majors. And they criticised mortgage brokers and financial advisors for poor advice influenced by commissions and ownership structures. And they also said that the regulatory environment, where the shadowy Council of Financial Regulators, comprising the RBA, ASIC, APRA and the Treasury, do not even release minutes of the meetings which set policy direction. You can watch our separate video blog on this report. On Thursday, the Treasurer released draft legislation to require the Big Four banks to participate fully in the credit reporting system by the 1st of July 2018. They say this measure will give lenders access to a deeper and richer set of data and enabling them to better assess a borrower's true credit position and their ability to pay a loan. This removes the current strategic advantage which the majors have thanks to the credit data asymmetry and the current negative credit reporting. We note that there is no explicit consumer protection in this bill relating to potential inaccuracies of data going into a credit record. And this is, in our view, a significant gap, especially as the proposed bulk uploading will require large volumes of data to be transferred quickly. It does, however, allow smaller lenders to access information which up to now they could not get, and so creates a more level playing field. Consumers may benefit, but they should also be aware of the implications of the proposals. And then on Friday, Treasurer Morrison released a report by King & Wood Mallison's partner Scott Farrell into open banking, which aims to give consumers greater access to and control over their data, and which mirrors developments in the UK. This open banking regime means that customers, including small businesses, can opt to instruct their bank to send data to a competitor. And so it can be used to price an offer or offer an alternative product or service. That's great news for smaller players and fintechs, and possibly for customers too. And it's bad news for the major players. The report recommends that the open banking regime should apply to all banks, though with the major banks to join it first. For non-banks and fintechs, the report wants a graduated risk-based accreditation standard. Superannuation funds and insurers are not included for now. In terms of implementation, data holders should be required to allow customers to share information with eligible partners via a dedicated application programming interface, not screen scraping. A period of approximately 12 months between the announcement of a final government decision on open banking and the commencement date should be allowed for implementation. From the commencement date, the 4 major Australian banks, they say, should be obliged to comply with the direction to share data under open banking. The remaining authorised deposit-taking institutions should be obliged to share data from 12 months after the commencement date, unless the ACCC determines that a later date is more appropriate. Then, of course, the Royal Commission into Financial Services starts this coming week. We discussed this on ABC The Business last Thursday. Lending practice is on the agenda, and that's highly relevant given the new UBS research, they of Liar Loans fame, suggesting that incomes of many more affluent households are significantly overstated on mortgage application forms. And then the BEAR, the Bank Executive Behaviour Regime legislation, passed the Senate. And as a result of amendments, small and medium banking institutions will have until 1 July 2019 to prepare for the BEAR, while it will commence for the major banks on 1 July 2018. APRA Chairman Wayne Byres spoke at the A50 Australian Economic Forum in Sydney. Significantly, he said that the temporary measures taken to address two-free mortgage lending will morph into the more permanent focus on, amongst other things, further strengthening of borrower serviceability calculations and assessments by lenders, strengthened capital requirements for mortgage lending, and the comprehensive credit reporting being mandated by the government, as we discussed. Adelaide Bank is ahead of the curve as it is introducing an alert system that will monitor property borrowers that are struggling with their repayments. The bank and its subsidiaries and affiliates will compare monthly mortgage repayments with borrowers' income ratios. In addition, extra scrutiny will be applied where the loan-to-income ratio exceeds 5 times or monthly mortgage repayments exceeds 35% of a borrower's income. But standing back and combined, data sharing, positive credit, banking competition and regulation are all up in the air or are already coming into force, and it appears that the big 4 incumbents are the losers as they are forced to share customer data and competition begins to put their excessive profitability under pressure. It highlights the dominance which our big banks have had in recent years and the range of reforms which are in train. As a result, the face of Australian banking is set to change, and we think customers will benefit. But wait for the rearguard actions and heavy lobbying which will take place ahead. Of course, the RBA left the cash rate on hold this week and signalled that the next move was likely to be up, but not for some time. Retail turnover for December fell 0.5% according to the ABS seasonally adjusted data, and this is the headline which got all the coverage. But actually the trend estimate rose 0.2% in December, which followed a rise of 0.2% the previous month. Compared to December 2016, the trend estimate rose 2%, and interestingly this is in line with average income growth. But there's really no joy for retailers in those figures. The latest housing finance data from the ABS shows a fall in flows in December. In trend terms, the total value of dwelling finance commitments, excluding alterations and additions, fell 0.1% or $31 million. Owner-occupied housing commitments rose 0.1%, while investment housing commitments fell 0.5%. Owner-occupied flows were worth $14.8 billion and down 0.3% on last month, while owner-occupied refinancing was $6.2 billion, up 1.2% or $73 million. Investment flows were worth $11.9 billion and fell 0.5% or $62 million. The percentage of loans for investment, excluding refinancing, was 45%, which is down from 49% in 2016. And refinancing was 29.5% of owner-occupied transactions, up from 29.2% last month. Momentum fell in New South Wales and Victoria, the two major states. In original terms, the number of first-time buyer commitments as a percentage of total owner-occupied housing finance fell to 17.9% in December, from 18% in November. The number of transactions fell by 1,300 compared with last month. But the ABS warns that the first-time buyer data may be revised, and users should take care when interpreting recent ABS first home buyer statistics. The ABS also plans to release a new publication which will see Housing Finance Australia and Lending Finance Australia combined into a single, simpler publication simply called Lending to Households and Businesses. We continue to have data issues with mortgage lending, with the RBA in their new statement on monetary policy saying it now appears unnecessary to adjust the published growth rates to undo the effect of regular switching flows between owner-occupied and investment loans, as they have been doing for the last couple of years. So now, investor loan growth on a 6-month basis has been restated to just 2%, more fluff in the numbers. Additionally, the RBA will publish data on aggregate switching flows to assist with understanding of this switching behaviour. More data this week highlights the pressures on households. National Australia Bank's latest Consumer Behaviour Survey showed the degree of anxiety being caused by not only costs of living pressures, but also health and job security and retirement funding, as well as Australian politics. But of all the things bothering Australian households in early 2018, nothing surpasses cost of living pressures. Over 50% of low-income owners reported some form of hardship, whilst almost 1 in 2 18 to 49-year-olds are affected. Next, despite improved job conditions and household reporting healthier financial buffers, the overall financial comfort of Australians is not advancing, according to ME Bank's latest Household Financial Comfort Report. In its latest survey, ME's Household Financial Comfort Index remains stuck at 5.49 out of 10, with improvements in some measures of financial comfort linked to better employment conditions, e.g. a greater ability to maintain a lifestyle if income was lost for 3 months, offset by a fall in comfort with living expenses. And we released the January 2018 update of our Household Financial Confidence Index using data from our rolling 52,000 household surveys. The news is not good, with a further fall in the composite index to 95.1 compared with 95.7 last month. This is below the neutral setting and is the 8th consecutive monthly fall below 100. Costs of living pressures are very real, with 73% of households recording a rise, up 1.5% from last month, and only 3% a fall in their living costs. A litany of costs from school fees, childcare, fuel, electricity and rates all hit home. You can watch our separate video on this. We also published updated data on net rental yields this week, using data from our household surveys. Gross yield is the actual rental stream to property value, but net rental is rental payments less the costs of funding the mortgage, management fees and other expenses. And this is calculated before any tax offsets or rebates. The latest results were featured in an AFR article this week. The results are pretty stark and shows that many property investors are underwater in cash flow terms. Not good when capital values are also sliding in some places. By state, Hobart and Darwin are the winners, Melbourne and the rest of Victoria, and then Sydney and the rest of New South Wales the losers. The returns vary between units and houses, with units generally doing somewhat better. and we find some significant variations at a postcode level. But the most significant finding was that more affluent households are doing significantly better in terms of net rental yields, compared with those in more financially pressured household groups. Battling urban households, those who are living on the urban fringe, on the edge of our cities, are doing the worst. We think this is explained by the types of properties people are buying and their ability to select the right proposition. Running an investment property well takes skill and experience, especially in the current rising interest rate and low capital growth environment. Another reason why prospective property investors need to be very careful just now. Finally, we saw market volatility surge as markets around the world gyrated following the good news on US jobs last week, which signalled higher interest rates. In our recent video blog, we discussed whether this is a blip or something more substantive. We believe it points to structural issues which will take time to play out, so expect more uncertainty ahead and further corrections on those we've already seen. This will put more upward pressure on interest rates and also on bank funding here. Overall then, a week which underscores the uncertainty across the finance sector and across households. This will not abate anytime soon, so brace for a bumpy ride. And those managing our large banks will need to adapt to a fundamentally different, more competitive landscape. So they are in for some sleepless nights. If you found this useful, do like the post, add a comment, and subscribe to receive future updates. I'm Martin North, Principal Analyst at Digital Finance Analytics. Many thanks for taking the time to watch.